What's the worst we can expect? Let's take a look at the first slide. So 46% of trading days over the last year saw SPY's IV rank print less than 10%. That's interesting. Yesterday's 1.4% drop in the SPY made the IV rank rise to 30, basically overnight. Basically what this means, we were in a period of very low IV for the better part of last year. Of course, with the exception of April, you see that spike on the screen. And then obviously the little line curving up on the very right-hand side, that's yesterday. So today, obviously, I think IV rank's down a little bit. I think if you look at SPY, we're back down to 27. So we've dropped a little bit. But that's kind of the setup here, right? So the question I wanted to pose, if we go to the next slide, is that when IVR is low, it doesn't take much market movement to cause it to spike. So we know that. So what are the worst case big moves that we can expect in the market if IV rank is coming off of a low? And I wanted to talk about this because a lot of we know that the outlier risk is present, but we also know that those humongous moves, they don't always happen in low IV. Sometimes they happen when IV rank's already high. So if we're just coming off of a period of low IV, what is the realistic worst case that we can expect?
That's a fair question.
Volmageddon. That's going to be your worst.
What is the worst case?
2017, 2018.
As far as, are you talking about as far as vol spike or as far as the actual market move?
Both, and specifically when IV rank is low. So both vol spike and the market move. Now this study is going to be in terms of IV rank because you've requested.
Well, obviously, as far as IV rank. And what constitutes a move? 1 day or is it multiple days?
This is 1 day moves.
1 day moves. Well, I mean, IV rank could theoretically double in a day. But the biggest move is probably going to be, I'm guessing, how far back does the study go?
So 1994, if IV rank is less than 15, okay, and you wake up, it's 15, what's the worst possible move that day?
IV rank doubling, the index moving. I'm going to say it's going to be lower than you think, 2.5%.
Okay, Nick?
I think it'll be 2018 with Volmageddon, that 1 day spike. But I don't know if
you don't know if it was started when it was below 15.
I think it was. I think Vol was at like.
It could have been. I don't remember.
I think it was at like 10.
Vol rank. This is IV rank.
IV rank.
Oh, I don't know.
It's hard because it's IV.
It's hard, yeah.
Because it was over that wipes the whole thing out.
Yeah.
All right, go ahead. Let's see what you got, Anton.
All right. Let's take a look at the study slide, number 3. Since 2004, I'm sorry, 1994.
1994? Were you even born, Anton?
No, I was not. But you were.
What are you saying?
Saying you're old.
Exactly what you said.
All
right. Calculate IV rank. Observe the largest up and down moves in the SPY and observe the largest up and down moves in IV rank. Given IV rank was either less than 15, between 15 and 30, between 30 and 50, or greater than 50. Okay, so what are these worst case moves? Given you wake up, IV rank is like 10. What's the worst that can happen on that day historically? And then as you get higher, what's the new worst case? Okay. We haven't really done this study in terms of IV rank. We've done it in the past to some degree in terms of VIX, but I wanted to standardize things with IV rank because that's the easiest number to see on the platform. Okay, let's take a look at the fourth slide. So the worst down move since 1994, here's your first statistic, when IVR was less than 15, was minus 3.9%. That's tough.
When was it?
You know what? You're gonna ask me this. It's too much stuff on the slide. I didn't put the number. I didn't put the date. I
think that's what I wanted. I thought.
I said 2.5%, but I was just guessing. So 3.9. Okay, that makes sense. But like you said, I knew it wouldn't have been the largest because it couldn't have been. Right.
No. So here's the kicker. The outlier risk in the middle IVR ranges was not that much more. So you look at when on the table, you look at the first row, less than 15. The biggest down day, 3.9%, biggest up day, 2.9%. Okay, so obviously the biggest down day bigger than the biggest up day. That's where you get the put skew. But if you go to the biggest down days, when IV rank even goes to 30 and to 50, it's actually not all that much more. It's 5.3, 5.8%. Now, of course, you get to the super high IV rank, then you get the bigger moves. But when you go from a super low IV rank to like 30 or 40, you're not taking all that much more outlier risk, but you're getting paid significantly more premium. So that's takeaway number one. When you have low IV rank, the outlier risk is still very present. Even though it's not the biggest, it's still, as a proportion, it's still very large. That makes sense?
Yeah, sure.
Makes perfect sense.
Now, here's the second kicker from this. Did anybody notice the second takeaway? If you don't read the third bullet, you wouldn't.
When you get when you get really high volatility, then the risk comes into play. It's basically telling you that, you know, you have an outlier risk when volatility is low and when volatility is super high. But when you're in kind of a middle range from 15 to 30, that's kind of your sweet spot.
Well, what it's saying is,
which is when volatility is, that's when you're getting paid the most to take the risk, and the risk is all kind of the same.
It's saying that when volatility is super high, that because that means the market's on its butt, that you have the biggest risk of an up move.
Exactly. And this is why sometimes we see call skew. If you look at the biggest down day versus the biggest up day, once you get above 30, so between 30 and 50 and greater than 50, the biggest up or the biggest move was actually to the upside, which is interesting. Compared to when volatility is less than 30, rank is less than 30, the biggest move was to the downside. So that's why most of the time you see put skew, like right now.
Yeah.
But when vol is super, super high, you tend to see call skew. Why is that? Because historically the biggest moves then are to the upside, which means it's priced perfectly.
Yeah, that's good.
So it just reaffirms everything's priced perfectly and explains the call skew and also tells you where the outliers are when volatility is low. Let's go to the fifth slide. Let's get some more stuff from here. Notice, now this is looking at the typical ranges. We put a little bonus stuff here. So this is like the standard deviation of a single day. What's the 68th percentile reasonable move on a single day when volatility rank is in a certain range, right? The typical moves become obviously larger when volatility rank goes higher. So when volatility rank is less than 15, your typical move in the S&P is 0.7%. Right now, that translates to about 38 S&P points. When you go greater than 50, your typical move with the same likelihood, that's the key, the same likelihood is now 110 points. So it's a totally different market. This is why we have to stay small when volatility is low, because we need to be able to have the capital to adjust for those increased, almost tripling of the moves when volatility rank goes high.
Yeah, that's interesting.
That's your fourth takeaway. Okay, let's go to the sixth slide. Now, although IV rank can fluctuate a lot in one day, now this is where we get to the highest the IV rank fluctuations. So number one, volatility rank can fluctuate a lot in one day, and the average drift in IV rank at extremes is twice as large to the downside as it is to the upside. In other words, when IV rank is large, it drops a lot quicker than it rises if it's low, right? And that's when we know that. That's pretty typical. That's why we don't usually buy premium. We only sell it because it does drop a lot quicker, about 2 points a day when it's greater than 50, and it only rises an average of less than 1 point if it's super, super low. So that's why we tend to sell premium as opposed to buy it. And then when we take a look at the biggest IV rank spike, actually there isn't the amount of points it can move is actually about the same wherever you are. So if it's less than 15, it could jump 50. It has jumped 51 points in a single day. If it was greater than 50, it's jumped to 100 in a single day. Obviously, the difference is, though, that if it's less than 15, that's a huge spike compared to if it's already greater than 50. So that's, again, why we keep capital on the side, because it can spike the same amount, but if it spikes from a place where it's low, it's going to hurt you a lot more.
That's good. That's really interesting. I like it.
All right. Let's wrap it up with the takeaways. So worst case outliers and low IV ranks were similar to that, to the mid to high IV ranks, but premium sellers can get paid much more juice and get further out, thus making the argument to taper back on premium selling when IV rank is low, because those outlier moves are still very prevalent and you're not getting paid as much. Biggest moves when IV rank went above 30 were actually to the upside, which explains the reason for occasional call skew, especially when the market's on its butt. And the third one, IV rank drifts lower much faster when it's high than the drift higher when it's low. Therefore, we tend to sell premium, not buy it. And that's a good little, lot of nuggets based on our research that we are affirming in this piece.
There are a lot of little nuggets in there. Yeah, I just, the one thing that I think, the one takeaway when I listen to this that I think you have to realize is that even though you have that upside risk when IVR gets really high, you have that upside risk in the market, you know, like the bounce back risk. The calls, it's hard to make. The markets are priced so perfectly that the calls are expensive. So then when the rally happens, they don't go anywhere.
Because volatility.
Right,
because volatility gets crushed.
Yeah.
And that's the part.
That's right.
So it's not like, it's not, that's why when IVR is high,
you're looking to sell premium.
You're looking to sell premium because the puts and the calls get crushed on the rally back.
Yes. Yeah.
When you get hurt is when there's a continuation of the move.